Welcome to the deep dive. Today, we're tackling something pretty specific in global finance. Foreign currency translation adjustments.
Yeah, it sounds complex, but it's basically about how big companies with operations overseas make all their financial numbers talk the same language.
Exactly. If you've ever looked at a multinational's report and wondered how they merge, say, euros and yen back into dollars, this is key.
It really matters for investors, stakeholders, anyone trying to get a clear picture of the company's health.
So if you're maybe digging into financial statements, boosting your finance skills, or just curious about international business works.
Then this is definitely for you.
Right. Our mission today is to clear up the main concepts, the methods involved, using the material we've researched.
Okay, so where do we start? Maybe the basic terms.
Good idea. Let's talk exchange rates first. Simply what one currency is worth in terms of another.
And you got different types, right? Like the rate right now, the spot rate or current rate.
Yeah, versus the historical rate, which is the rate back when, say, an asset was bought.
And then there's the weighted average rate, often used for things happening over the whole period, like revenues or expenses.
Okay, and then this idea of currency denomination.
Ah, yes. That just means the currency a specific transaction is fixed in, like the invoices in euros.
Got it. Then we have the reporting currency, usually the parent company's currency, like US dollars.
And the functional currency, this one's super important.
Why is that?
Well, the functional currency is the primary currency the foreign subsidiary actually operates in, where it generates cash, pays bills, its main economic environment.
Okay, so the functional currency is the driver, and it determines whether we do translation or remeasurement.
Precisely. Two different processes. Translation is when you restate from the functional currency to the reporting currency.
Yeah, remeasurement.
That's needed when the subsidiary's books aren't actually kept in their functional currency. Maybe they use a local currency day to day, but their functional currency is actually the US dollar, perhaps because they're so integrated with the parent or they're in a highly inflationary economy.
Right, okay. And one more quick distinction, monetary versus non-monetary items.
Yeah, simple enough. Monetary items are things like cash, receivables, their value is fixed in currency units.
Whereas non-monetary things like buildings or inventory, their value isn't fixed in that same way. It can fluctuate more with economic conditions beyond just exchange rates.
Exactly. And knowing that difference matters for how we convert.
So let's connect that. Method one, translation, also called the current rate method. When do we use this?
You use translation when the foreign subsidiary's functional currency is its local currency. Simple case, mostly.
And how does it work? What gets converted at what rate?
Okay, so first the income statement, and most items use a weighted average rate for the period. Then the balance sheet, assets and liabilities get translated at the current exchange rate, the rate on the balance sheet date.
But not everything on the balance sheet.
Right. Equity counts are different. Common stock, paid in capital, those use the historical rate from when the stock was issued. Retained earnings is more complex. It sort of rolls forward.
Okay, so if you use different rates, things won't balance automatically. Where does the difference go?
Ah, that's the translation adjustment. It's basically the plug figure needed to make the dollar balance sheet actually balance.
And crucially, it doesn't hit the main profit and loss, right?
Correct. It goes into other comprehensive income, or OCI, kind of a separate holding area on the equity section of the balance sheet. Doesn't affect net income directly.
Got it. Now, method two, remeasurement. The temporal method. When is this one triggered?
This happens when the functional currency is not the local currency. Like our example earlier, maybe the functional currency is the US dollar.
And the conversion process is different here.
Yes, quite different. Here you sort of remeasure as if the books had been kept in the functional currency all along.
How does that work with the rates?
Okay, balance sheet first this time. Monetary items, cash, receivables, payables, use the current rate. But non-monetary items, inventory, property, plant, equipment, use the historical rate from when they were acquired.
Interesting. And the income statement?
That follows the balance sheet logic. So items related to non-monetary assets like depreciation expense or cost of goods sold use the same historical rates as the assets. Other income expense items generally use a weighted average.
And the balancing item here, does it also go to OCI?
No, and this is a major difference. The balancing figure under remeasurement is a remeasurement gain or loss, and it flows directly into the income statement. It does impact net income.
Okay, that's a huge distinction. Let's make this concrete with the Christie Corporation example. Scenario one, local currency IS the functional currency, so we use translation.
Right, using the sample numbers, translating their LCU financials might give you, say, Dollar sales around $67,000, maybe net income around $5,300.
And you'd see that plug figure, the translation adjustment sitting in OCI. Maybe it's negative $17,000 or so in the example.
Exactly. Doesn't touch that $5,300 net income figure.
Now, scenario 2, US dollar is the functional currency, even though they operate locally. So we use remeasurement.
Yep. Now things change. Dollar sales might still be $67,000 using the average rate, but because of the different treatment of non-monetary items and related expenses,
The bottom line changes.
significantly, net income might jump to, say, $11,000 in the example, much higher.
And instead of an OCI adjustment,
You'd see a currency gain or loss maybe around negative $7,000 in the example reported directly within that $11,000 net income calculation.
wow. Okay, so same underlying foreign operation, but depending on the functional currency determination, you get very different net income figures reported.
That's the core takeaway. Functional currency dictates the method, and the method dictates where the currency impact shows up, OCI or net income.
And that's just critical for anyone analyzing these companies, comparing them, or understanding how volatile exchange rates might be affecting their reported profits.
Absolutely. It adds a layer you really need to be aware of.
So, a final thought for you listening. Think about how really volatile exchange rates might paint quite different pictures of a company's performance and financial strength purely based on whether translation or remeasurement is being used. That highlights some real complexities in global finance, doesn't it?
It certainly does. Something to keep in mind next time you look at those consolidated statements.